Good evening and welcome to the second episode of The No Nonsense Investor. If there's one question that haunts the mind of every investor in the world right now, it's how do we shield ourselves from inflation? Since the outbreak of the COVID-19 pandemic in early 2020, governments have printed money in the trillions, dramatically increasing the money supply in order to protect societies from the economic effects of the pandemic. And as governments impose lockdown measures to shut down economies, demand for raw materials, energy and labour initially fell off a cliff. However, since the advent of the COVID vaccines, societies are now reopening and the balance has been turned on its head. There are now not enough resources to meet our demands in many areas. The modern car is basically a load of microchips or semiconductors attached to some wheels, and there's now a global shortage of these semiconductors, meaning new cars can't be built fast enough, and this in turn has led to a spike in prices for used cars. Commodities like oil, gas, timber and coffee have shot up in price, and there's a "we're hiring" sign on the back of every heavy goods vehicle in the United States. All these factors are causing inflation to skyrocket, and it's this rise in uncontrollable external costs of things such as shipping and raw materials that puts pressure on businesses all over the world, including those from within your investment portfolio. Investors are concerned about whether these rising costs can be absorbed, and if not, whether they can be passed on to customers without destroying demand for their goods and services. Traditionally, assets such as commodities and gold are seen as inflation hedges. However, these assets are non-productive, they don't compound over time, they have a tendency to crash, and their long-term returns are no match for great growth companies. So if great companies are the best long-term investments for us, the question we must ask ourselves is what qualities we should look for in them that allow them to shield themselves from this inflationary environment. These qualities can be called their inflation shields. If you're enjoying this video so far, please leave a comment below, click the like button and subscribe to the channel as there's plenty more videos to come. Anyway, to business. What qualities can help shield our businesses from the negative effects of inflation? The first inflation shield happens to be one of the most underrated fundamentals of all. We need to look for companies with a high gross margin. But what is gross margin? Well, it's been said that if gross margin was the C, net margin would be what you could get out of it with a net. And for this reason, most investors tend to focus on the latter and ignore the former. After all, why do we care about the other fish in the sea when we can only eat the ones from our fishing net? The answer is that inflation makes our sea smaller, and a smaller sea can mean a lot less fish in our net. Gross margin equals revenue minus cost of goods sold. Revenue is the total amount of money generated from sales for the period, while cost of goods sold, or COGS, also known as COGS, refers to the uncontrollable external costs we discussed earlier, the price of raw materials to produce goods, for example the coffee to sell at a coffee shop, or the metals and other elements used to create semiconductors. As you can imagine, a company with revenue far higher than their cost of goods sold will have a high gross margin, and should the cost of goods sold rise due to inflation, this may be easier to absorb without it impacting the net margin, what profit there is left over. A company with revenue only marginally higher than their cost of goods sold will have a low gross margin, and therefore there isn't much fat left to absorb these rising costs of goods sold, meaning this will impact the net margin more seriously and sometimes eliminate it entirely. Now we'll see an example of how a high gross margin can protect a company from inflation. Here are two companies, Company A at the top and Company B at the bottom. You'll notice that Company A has a high gross margin of 70% and a low cost of goods sold of the remaining 30%, whereas Company B has a low gross margin of 30% and a higher cost of goods sold of the remaining 70%. For the purposes of this exercise, we'll assume that both companies currently have the same net margin of 20%, which is what most investors are interested in. However, let's see how they each fare should inflation rise by 5%, increasing the cost of goods sold, those uncontrollable external costs, by this same percentage. We can see that for Company A, increasing its cost of goods sold of 30 by 5% raises it to 31.5%, and this results in a 7.5% decrease in its net margin. Not ideal, you might say. But let's see how Company B with its lower gross margin fares. The cost of goods sold increases by the same 5%, but as Company B's cost of goods sold represented a much higher number of 70 initially, the 5% increase adds on 3.5% for uncontrollable external costs, and this in turn reduces its net margin by a staggering 17.5%, a significantly larger reduction in net margin than for Company A. As we can see, a high gross margin allows companies to absorb rises in cost of goods sold brought about by inflation with less of an impact to their net margins, meaning profits and earnings are more likely to hold up during inflationary periods than companies with a lower gross margin. I know what you're thinking. Can't a company take action to defend themselves against rising prices by simply putting up the prices for the customer? Well, the answer is yes and no. The ability to raise prices for the customer depends entirely on whether the customer is willing to pay it or not. There's no use raising prices if this results in weakened demand for goods and services. The ability of a business to raise prices for customers without it affecting demand is called pricing power, and this is our second inflation shield. Now, I love Marmite, and like the hotel inspector Alex Polizzi and ex-Prime Minister Margaret Thatcher, a poached egg on Marmite toast is my favourite breakfast. In fact, and this is a trigger warning because what I'm about to say will upset many viewers, I even have Marmite with pasta. That's right, with butter, pepper, parmesan cheese, it makes an incredible dish. Anyway, I digress. Last year I went to the supermarket to buy some Marmite and noticed to my absolute horror that the price had gone up. As it happened, the owner of the Marmite brand, British consumer staples company Unilever, had put up prices of all their goods in response to the rising costs of shipping and ingredients, these uncontrollable external costs we discussed earlier that rise with inflation. I'd love to tell you that I, the Marmite customer, stormed out of the store in protest at the price rise. I did consider it, but that would have involved putting supermarket own brand yeast extract on my pasta. And that would have been weird. So you know how this story ends. I coughed up the extra pennies and left the store happy, Marmite in hand. Now, what we have seen in my Marmite episode was an example of pricing power in action. Unilever knows that the Marmite brand is so beloved by its customers that should they raise the price, customers are likely to pay up. A less loved brand may not be able to do this and therefore would struggle in an inflationary environment. But pricing power isn't limited to yeast extract. Another example is Microsoft. Microsoft software is used by businesses the world over for emails, documents, spreadsheets, and online meetings, to name a few. The software subscription is a relatively low cost for the businesses that use it, and changing the entire software system is both costly and troublesome for them to implement. Therefore, when Microsoft raises prices, customers are likely to pay it rather than switch to another type of software. And this phenomenon of sticky revenue contributes to Microsoft's pricing power and also provides a protective moat around the business which defends against the competition and protects against inflation. So in today's video, we've looked at two inflation shields, high gross margin and pricing power, but it's important to remember that the two are actually linked, because often the latter is required to achieve the former. If a company can raise prices faster than inflation, logically the gross margin should expand. To give your portfolio an edge, one technique you may want to employ is to calculate the weighted averages of gross margin for all the holdings within your portfolio and try and make sure this weighted average is considerably higher than that of the index. This will mean as inflation rises, the companies within your portfolio should be able to absorb the cost better than the average company. There is, however, a word of caution. Although high gross margin and pricing power can and do protect businesses against inflation, the value of stocks can still be negatively affected during inflationary periods. And this is because interest rates often have to rise in response to inflation, and this reduces the relative value of future cash flows from our businesses. However, that said, it's important not to panic. High quality businesses tend to do well over time, even in times of rising interest rates. For example, the federal funds rate rose to 2.4% in 2018, but that didn't stop high quality stocks delivering stellar returns since that time. So if you enjoyed today's video, please click the thumbs up and subscribe to the channel, share the link with your friends and connections, and leave a comment in the comment section below. There'll be plenty more videos like this in the future. And of course, no nonsense.